And really what's happening is that there was so little investment in new technology through the period of bankruptcy for GM and Chrysler. All that pent-up technology is now hitting the showrooms, and average vehicle age being at 11+ years. People driving in onto the showroom and looking at these products are just fascinated by the new tech that's out.
Yeah, it is interesting. Talk to me about that dynamic. I mean, there's so many dynamics at play, right? There's the economic state of the union, if you will. There's the state of the debt markets, super low interest rates right now. But the collapse of the subprime markets and the housing market in 2007 and then 2008, what happened there? You know, even when you look at a company that didn't go bankrupt like Ford, you can still see a significant collapse in their tech investments at Ford in terms of the billions of dollars that they spend in R&D.
Sure, and if you figure that even with Ford's near miss, GM and Chrysler's bankruptcy in 2009, look, the writing was on the wall years before that, so they started to rein in that tech spending well before the bankruptcies, and what you wind up with is really no tech spending going into post-bankruptcy. Profitability starts to come back maybe 2011, 2012, and as that spigot opens in investment spending, that's the products that we're seeing in the showrooms now. So we have basically a lost generation of technology where if you think about a noticeable difference in automotive technology in about an 8-year window, we've compressed that to about a 4-year window. So people driving onto a dealer's lot with a 2010 model year, completely different tech from what they're seeing in even leftover 2014s.
Yeah, it's fairly interesting. I mean, every year when I go to the CES show, and thankfully I didn't have to go this year, but every year they tell me that this is the best and the brightest, and that this year's models have got all kinds of new bells and whistles and gadgets and so on. It sounds like what you're saying is we're really about to enter into an age of significant technological innovation from all of the automakers because of the downturn in R&D spending from back in 2007 and 8.
Sure, and if you look at it, safety is a good example, and there's 3 main areas that we talk about. Safety is obviously one of them, fuel efficiency, and just engine efficiency in general is another, and the other would be infotainment. And if you look at the safety side of things, we've almost leapfrogged over collision warnings, right? We went from protecting you after you have a crash with airbags, and side curtain airbags and knee airbags, and then we go to collision warning, and we've sort of skipped right over that, and now we're going to collision avoidance, where we have automatic braking, we have adaptive cruise controls, we have lane keep assist, where the vehicles will actually steer themselves to keep them in the lane, and it's almost as if we totally bypass the effort where it says if the vehicle is going to warn me, well then just fix it in the first place. And speaking of autonomous driving and self-driving vehicles, this is the technology that is the incremental steps to get there. Little by little, we start to realize that we can make the machines better drivers than we are, and they probably already are better drivers than we are in a lot of cases.
Now, at the same time, there's been a significant increase in the price of cars that seems irrespective of at least the sales in vehicles overall, blowing right through the recession. But I wonder if that's about easy credit, subprime lending, which is such a dominant part of the car business now and wasn't 10 years ago.
Yeah, and if you look at the price chart, you have the $28,000, $29,000 average transaction price in the U.S., now up over $32,000 for the full year of 2014. And really what that's doing is it's additional tech in the vehicles, but that additional monthly payment increase is being offset by lower interest rates, at least in terms of a payment. And then if you think about total cost of ownership, the lower gasoline prices play into that as well. So what you're seeing is consumers go to dealerships and see all this new tech, so they're willing to pay more because what you're paying for in tech, you're getting back in your lower interest rate. And easy credit, you can roll your negative equity right into your new loan too.
I guess I was just looking at that chart thinking about Janet Yellen telling us earlier today there is no inflation, and then I see that price. But I guess what you're saying is that it's all netting out right now with lower oil prices and interest rate payments coming down. But when interest rates come back up, it could be a rapid turnaround.
Well, yeah, and that's an interesting thing too, right? So if you look at the low interest rates, the other area of new vehicle sales they're having an effect on is lease penetration, which is at an all-time high. Up near 27, 28%. Normally that would be about 20. And what that means, if you think about traditionally 3-year lease terms, probably somewhere around 2017, and if rates stay low even beyond, we're going to get this flood of off-lease vehicles coming back into the market. And if these are 2014, 2015 model year vehicles coming off lease, they're going to have a fair amount of technology. And now what you're going to get is good quality off-lease vehicles competing with the 2018, 2017 model year. And higher interest rates. So now the used car market is going to start to look like a better deal. Right now, it's so close in terms of the affordability gap, everybody just buys new.